Good afternoon, I'm Ted Lucas of Hartford Funds. I want to give you all a commendation for coming to this talk. You have great curiosity. If you read the title, Portfolio Aesthetics, Can Risk Allocation Be Beautiful? Your curiosity must be high because you must be wondering what I'm going to be speaking about. I'm going to start with the premise that understanding the aesthetics of portfolios can help us make better investment decisions. A big theme of this conference has actually been timing and investor decision-making that often is predicated on views of past performance. And Matt and Dave gave a talk yesterday that explored this and looked at dollar-weighted returns, not only for active mutual funds, but also for capitalization-weighted ETFs and strategic beta ETFs, and dollar-weighted returns in all circumstances are substantially lower than the actual returns of the funds themselves. So with the advent of rules-based strategies that are now delivered through ETFs, we call that strategic beta, smart beta, alternative beta, we now have an opportunity, I believe, to look at characteristics of a portfolio. So basically, what does the strategy generate? And those characteristics can tell us something about what to expect for outcomes. And we can make better judgments comparing different strategies to one another. Now, I'll get into that. But this is critically important. If we can enable our clients as advisors, as investment managers, new ways of looking at portfolios and strategies and create higher conviction to hold the strategies, we can perhaps overcome some of this dilutive timing effect. Beauty leaps out to the person who understands it. Robert Grudin, a favorite author of mine, wrote a book, The Grace of Great Things, principally about creativity and innovation, but certainly written with a very artistic and philosophical sensibility. This one insight, beauty leaps out to the person who understands it, really stuck with me because it said something. It said that beauty can be certainly innately appreciated and apprehended, but actually understanding beauty and understanding sources and understanding what makes something beautiful, be it an object, it could be a relationship, that there actually is knowledge to be gained. We were encouraged to make these short talks styled on TED. And so leaping into aesthetics here in a minute, I will just say that I'll try to make this a little more colorful than an academic investment lecture and add some personal narrative. That's the TED style. So I think guitars are beautiful. This is one of my beloved Gibson Les Pauls. I've been married 20 years. My deal with my wife is that I can buy one new guitar a year. She's now claiming that that contract has outlived its useful life, but I have a few guitars around the house. So if we look at this guitar, there's aesthetics being basically the study of beauty. It's a branch of philosophy. There's three schools of thought. I don't think they're mutually exclusive. Let me explain. There's the objective school, which basically says the object itself that we are looking at or that we're perceiving has innate beauty to it that's universal. So in this case, you could look at this guitar and say, well, it's beautiful because of its shape, its craftsmanship, that flame in the wood, the symmetry of the object. It has inherent beauty. It's not a matter of opinion of the subject. The subjective view is basically beauty is in the eye of the beholder, which says, some of you in the room will look at that and say, okay, it's a guitar. Others might say, hot damn, it's a beautiful guitar. So that may speak to your own passion for music, your own experience with guitars, but essentially there's varying degrees of perhaps perception of beauty. The third and final school, which I really want to focus on today, is really what we could call the purpose-based school, which says that an object is beautiful. It may have inherent qualities, but it actually is what the object can do, what it can create, what it can generate, what are its generative properties. Of course, with guitars, that's music. To continue on in the personal narrative vein here, my own experience with guitars started in 1982. I was a 15-year-old growing up in New Jersey. In 1982 in New Jersey, if you were a teenage boy, there was only one guitar player you sought to emulate who was breaking onto the scene at the time. That was Eddie Van Halen. So to every 15-year-old boy in New Jersey playing guitar, learning how to play Eruption, as an example, was really the ultimate accomplishment. And many hours spent back in the bedroom driving my long-suffering parents crazy, but basically playing over and over and over again, listening to the songs, playing along with them. I developed a certain style of playing, as you would expect if that's the genre that you're studying. It was generally fast, loud, aggressive, kind of one-dimensional. So really not a lot of thought necessarily given to what was being played, but really the technical aspect of it. And I had a period where I had a hiatus from guitar playing, but 15 years ago when my wife and I moved out to California, moved out to San Francisco, I decided to be more intentional about playing. And I picked the guitar up, and it all came back very quickly, quite frankly, but it sounded the same, which was cool if you were 15. And I was 35 at that point. And I really wanted to develop more of a soulful way of playing, something that had more dimensionality to it, more color. And my remedy for that was actually taking some lessons and trying to play with some really accomplished, mostly blues players. The person who had the greatest influence on me in that regard is someone who goes by the self-proclaimed moniker, the White Jimi Hendrix, who I took lessons with for a period of time. And we would play, I would play the underlying structure, he would solo on top of that, and then we would trade off, I would do that. And we were playing one time, and he stopped me, and he said, "Ted, you have a problem." And I said, "That's why I'm here." And he said, basically, you know, you're a better technical guitar player than I am, you're faster, you're more precise, but you are very, very limited because you're locked into a genre, one single genre, and it's fast. And I'm gonna get you to think about three things. He's like, if you don't learn anything from me, think about these three things. First, you start thinking about music, you have to understand what is underneath the music. What are you playing on top of? What's the context? So yes, you need to know key and tempo, but you also need to go deeper. You need to really hear what's going on underneath you and then unify with that, what you're playing on top of it. Second is intention. You're launching into these blazing solos, but it's all muscle memory. It's all calisthenics. That's why there's no soul to it. Basically, if you think about most great guitar players, the great artists, any blues player, there's an idea in mind, there's a story that they want to tell, and then they use that as structure to actually create the performance. Finally, this concept of balance. He used this example, which I thought was fairly creative. He said, "Hey, Ted, what two things does every movie have?" Right, a hero and a villain. A hero and a villain, an antagonist, protagonist. So what happens, right? In the end, generally the hero wins, but not always. Sometimes it's unresolved. But what he said is, think about how you structure a screenplay, right? Basically, there's an arc to the story, but the hero and the villain, their characters have to be developed, and then there's some oscillation. Sometimes the hero's on top, sometimes the villain is winning, the hero's suffered a tremendous setback. It all runs along an arc, but there's some balance, there's some symmetry to that. And in the same way, thinking about how you're playing guitar and how you're constructing these solos, you need to be thinking about balance. What I'm now going to try to do is connect this idea that music composition and portfolio composition, designing strategies that respect context, that really seek to understand what we have to work with, that are intentional in terms of what the outcome and what the specific characteristics are that we're seeking to achieve, and that has balance. That can help us become better investors, and it creates a lens where we can explore the relative beauty of different investment strategies. Let's start with context. We won't spend a lot of time on this, but simply to say that this has been a theme of the conference as well. We've had a 3-decade period over the last 35 years where just owning beta has been tremendously rewarding. So 60-40 portfolio, US stocks, bonds, S&P 500, Barclays Ag, compounded at about 11% for the last 35 years. That was actually 1982 at inception there. I don't think it had anything to do with when I took up guitar. So if you compound 11% for 35 years, that you have 30 times your starting capital. There's just tremendous power of compounding. That's before costs and taxes, but even if we haircut that, it's substantial. We need to think about what were starting conditions then that provided the launch pad, if you will, for what was such an anomalous period for returns. Well, valuations were significantly different. So some examples here for stocks, depending on how you look at valuation, 2 examples here, both just trailing PE as well as cyclically adjusted PE looking back over 10 years. What we see now is stock valuations are roughly 3 times that, or perhaps closer to 4 times what they were then. Doesn't necessarily mean that stocks are poised for a very substantial catastrophic implosion, but it does say something about forward-looking returns. Similarly with bonds, we can understand that going back to the early 80s, you had very significant inflation. Inflation's running 12, 13%. The 10-year Treasury peaked at close to 15% relative to, even though it's moved upwards a bit, 2.5% currently. So again, mathematics would say structural beta returns, if you take valuation into account, will likely be lower. We also look at what the structural fundamentals are, what's economic growth, what's happening with inflation, what are demographics, what about productivity growth, what about trade? What about the spread of capitalism, democracy? There were a lot of positive tailwinds over the last 35 years that fueled this dual bull market in stocks and bonds, again, starting with the low valuation. And you could argue with populism, authoritarianism, some of the retracement on trade, some of these may be turning into tailwinds. That will likely also contribute to more muted beta returns. And then with all of the geopolitical uncertainty, with the unwind of the central bank liquidity infusion, with the potential change in interest rate regime, I think we will likely also be experiencing greater turbulence looking forward that will recur from time to time. Those are very significant challenges. I think we've been lulled into a sense of complacency since the financial crisis, because stocks have actually compounded at north of 15% over that period. Bonds have done just fine, surfing down to 1.5%, and volatility has been muted. But I think we really need to be aware of this, and I think we need to apply even greater creativity and insight to helping our clients achieve the growth that they need to fund future obligations, retirement, and so forth. Let's turn to intention. Okay, so what is this thing? This is a visual that one of my partners in San Francisco, who's a talented industrial designer from New Zealand, put together. And I asked her, I said, hey, let's look at different equity regions, and let's kind of find a way that visually is impactful and intuitive in displaying how capital is allocated. So this is an example taking emerging markets. So what we have here along the outer ring here, where you have the different colors with Brazil at the top there in blue, the size of the ring slice, if you will, is the capital allocated. So what you immediately recognize by looking at this is there's quite a bit of asymmetry. You've got a lot of concentration in certain countries and then underrepresentation in others. In this case, China, South Korea, Taiwan, depending on what index you're looking at, typically constitute 50 to 55%. So very significant idiosyncratic risk in those three countries. If you expand to the top 10 countries, typically 90% of the capital is allocated there, leaving the other 10 or 12 to absorb the remaining 10%. So definitely sort of an asymmetry in that allocation. A lot of the large companies are very much export-based and linked to developed market economic cycles like the three North Asian countries, or heavily dependent on the commodity cycle, where a lot of the smaller countries are actually earlier in their development cycle, more representative of the local economic growth that investors are looking to access via emerging markets. The inner ring, the gray areas, are the risk allocation. So this is downside risk contribution. So interestingly, you see, of course, also great asymmetry, but a country like Brazil that's smaller than, say, South Korea actually contributes more risk. So smaller dollar allocation, but more risk. That should make intuitive sense. The real is much more volatile than the yuan. You have a much higher degree of commodity cycle sensitivity there. So again, if we were to being more intentional, we might want to correct for some of these imbalances. And then the outer spikes that you see there are actually individual company concentration. And as many of us are aware, there's very significant concentration in some of these countries in just one or two stocks. So with Korea, Samsung as an example being 25% of the allocation. So this is what cap-weighted indexing more or less is giving you as risk allocation. It's not intentional. It is coming as a result of basically investor preference in the market. So the size of countries, companies, basically based on what just happened. Also, to some degree, a remnant of how mature the markets are and how large their capital markets are. But I think we could all agree that while cap-weighted indexing is an extraordinarily valid form of investing, it's cost efficient, it's tax efficient, it's return efficient, it gives you the market return, you're assured of that. Looking at this visual might cause you to question whether it's risk efficient. And that's a hallmark, I believe, of portfolio aesthetics, where through greater balance, through greater intention in how risk is allocated, investors can be served in a more deliberate way. Let's turn to factors. That's been another large topic at the conference here over the last several days. We'll not go into detail here, but what you're looking at in this visual is essentially taking the 5 commonly understood risk generating factors: value, quality, momentum, size, and low volatility. And what we did here, just for the sake of example, is formed essentially proxy portfolios that sought to represent each of these factors individually. So low valuation, to my right, Basically, for the developed markets ex-US universe, that's what we use for these proxy portfolios, we simply took the 300 cheapest stocks. We used a variety of different measures of value, but basically the top quintile. For momentum, the top quintile, the best 300 stocks relative to trailing 12-month returns, and so forth and so on. The point of this slide is this. Unless there is an explicit control for, let's call them collateral or residual factor exposures, there is no such thing as a single factor portfolio. Again, if you use value as an example, you go straight at value without controlling for other factors, you're going to have some residual exposures. It's been well documented that value and momentum typically, they're very complementary, but typically value stocks are not momentum stocks and momentum stocks are not value stocks. So you end up with a negative loading on value. It's also very common in value strategies to emphasize sectors that might be more highly leveraged or more volatile, like energy, financial services, industrials, and so forth. So what you often end up with, you could have a value exposure that's positive, but then on an unintended basis, have negative exposures to some of these other rewarded factors. So you essentially have a long-short multi-factor portfolio. That would be another way of defining that. The danger in that, if it's not recognized and not understood in terms of portfolio composition, is you can have periods where value is underperforming, like it has over the last 3 years up until very recently, and then some of the other factors that you're essentially short are performing well and generating positive excess returns. So basically your long book and short book are both going against you, and you can have protracted periods of underperformance. I think that the premise of multi-factor investing, which also recognizes that factors are not eternal, so while they may generate excess returns through a market cycle over a longer period of time, they're very regime dependent. And again, if you're not confident that you can predict the regime that you are about to enter, the risk regime or the macro regime, then the logic of multi-factor investing is better to own across the different factors that generate premiums, allow their inherent diversification properties, do that to produce greater return, excess return persistence, or risk-adjusted return enhancement. So if you think about that, a portfolio, our aesthetic lens, is that if a portfolio exists to compound capital over time and do that at a superior rate relative to whatever it's being compared against, the cap-weighted benchmark or a competing strategy, two ingredients of that. One is offensive, the second is defensive. Offensive is basically generating returns that are above and beyond market beta. The path to that, as we've discussed here, a potential path is to systematically source factors and do it in a more balanced way. The second aspect of a portfolio, the defensive factors, so things like diversification levels, things like forward-looking risk. One of the things that we've been working on over the last several years is developing tools that we can use for our own strategy, prototyping, R&D, our own internal research effort, as well as giving advisors the ability to look deeper into portfolio properties. So I'm going to suggest that there are, in a visual way, there are lenses that we can create where if we have some basic principles and beliefs, we can see whether or not those are expressed in a portfolio, and if they're expressed, how positively or how impactfully are they expressed. So if we go back to the factors and we form the belief that all things being equal, having stronger and more balanced exposure across the 5 risk factors is a positive aspect of portfolio construction. It suggests that there's the opportunity to enhance the pure beta return. What this chart is showing, a quick explanation, the horizontal axis is basically the combined factor score for each of the stocks. The plots are the stocks held in 2 different portfolios. I'll explain that in a minute. So as you move from to the right of the center point, essentially you're having more positive expression of factors. To the left, those are stocks that have negative expression across the series of factors. The vertical axis is the actual weight of the stock in the portfolio. So 2 portfolios here. The gray plots that you see is just the cap-weighted universe, stayed with developed markets ex-US. For this example, conveniently, there was a product that, a strategy that we thought we could contrast in a clear way here. So this is our developed markets ex-US strategy. And what you're looking at with the gray plots is the organization or the allocation of risk within the index. And what you can see is roughly half of the stocks have either neutral or negative expression of the factors. Also, you'll see significant concentration, particularly around the center point line there. And many of those stocks either are negative or neutral. So no evidence of design, you're just getting risk allocation, as in the emerging markets example, that the market gives you. The blue plots, on the other hand, are the strategy that we've created to address this market, again, with very intentional design and a very intentional output in terms of what we're looking to generate. And again, principle is maximum expression of factor exposures in a balanced way, and where you're allocating progressively more capital to those securities with stronger factor expression. So up and to the right, the evidence of design here, up and to the right on the blue plot, for the blue plots, really speaks to that intention being realized in portfolio characteristics. Other ways of looking at it, we can look at simply the factor scores on an individual basis at the aggregate level in a portfolio. Again, this is showing one strategy, but having an apples to apples basis to compare strategies or contrast a strategy against a cap-weighted index, I think really can give us greater insight in making judgments where there's quite a bit of, I would say, variation even in the multi-factor universe. It all kind of sounds the same, but if you actually look at the portfolio characteristics that each process generates, there's a lot of variation. The second aspect, very quickly, of a portfolio is its defensive characteristics. Again, we can look at diversification across countries, currencies, sectors, companies. That says something about risk. But one of the other beautiful things about having pure transparency in the ETF structure in a rules-based process is that we have real-time securities weights and holdings. So while we can look at the historical volatility of a strategy or its downside participation, I'm personally more interested in the forward-looking risk characteristics. And again, some of the things that you can look at: forward-looking volatility, forward-looking value at risk, downside risk. We can apprehend those things, again, using the transparency the ETF structure provides. We can also look at downside scenario risk. So to try to tie all of this together, the key theme is we think about investing. We, in aggregate, as investors, have not covered ourselves in glory in terms of how we've made decisions about what investments to hold, when to sell them, when to buy the new thing. That's the timing effect. I really believe there's a great opportunity. It gives me a lot of hope that we can establish new ways of assessing strategies. And again, it's systematic rules-based strategy as opposed to discretionary strategy really lends itself to this. So the strategic beta universe is a great example where we can develop an eye for beauty. If we have principles, if we believe that factor enhancement, strong, balanced factor exposure, and then diversification in either explicit risk control or risk that is being managed to a specific target or index, those combination of things can be visually seen, and we can develop lenses to do that, which I will offer for anyone in the audience here, our little application that I've showed some lenses from, we call Risk Genetics. It's been really useful for us, but also with advisors that we work with to compare and contrast strategies. So thank you very much for joining us today. I hope there was perhaps some new ways of thinking about things. That's always the objective of a TED-style talk. Thank you.